Good morning. This is Beth Orcliffe with IMES Insurance Agency Marketing Services. I am here with Nick Majors from Pac Life. We will be discussing life insurance as a separate asset class. So we're excited about the topic here for you today. As at the beginning here, I'm just going to do a brief commercial for IMES. I know that I have agents that are new to IMES or have not done business with IMES, or maybe you're an existing agent just that doesn't remember all of the services that IMES can provide. So I'll get through that quickly, and then we'll get into the meat and potatoes with Nick. Um, so as a new producer with IMES, we always want to give you an incentive to get business in with us as quickly as possible so that you can see how our service can help with your business. And so as motivation in the first 6 months, if you meet certain levels of production, we're going to give you some gifts or freebies here. So $100,000 level or 10,000, I'm sorry, 100,000 of annuity premium or 10,000 of target life insurance would be 750 in cash or an iPad, or you go up to the 750 level of annuities or 75,000 of target premium. Then you've got Retirement Boss Radio, video campaigns, etc. We always enjoy getting referrals from our advisors. Our business isn't much different than yours, and that the best people that we can do business with are the people that you know in the business. So when you do refer an agent to us and they end up and they do one contract with us, we're going to give you a $50 bonus, and then you can earn thousands of dollars off of their production. That is not a haircut off of their commissions or yours. That is out of IME's pocket. But for everything that they write, you're going to get a small percentage off that business. We do offer marketing reimbursement. And so the way that works is for every 100,000 of annuity premium, you get $100 of marketing reimbursement. Single premium life insurance for every 100,000, that's 200 marketing dollars. And for target life premium 10,000, you get $200 of marketing dollars as well. We have a tremendous back office support when it comes to the life insurance or life insurance sales directors as far as designing your case, pre-shopping your case if there are any kind of health needs. You've got your case management team that helps us get the new business all the way through underwriting and getting you paid. We've got our website, which is a tremendous amount of support there. And then, of course, we have our website. And I do have a webinar out there on YouTube on how to use our website, especially as it refers to life insurance. But you can do a lot of things here on our website as far as quotes, submitting business. There is a support tab that has a sales resource library, which has a ton of information on there, pre-approach letters. It has fact finders, also calculators, lots of different presentations out there. I spend time on that quite a bit. I learn something new every time that I'm on that link on our website. We've got a few ways of submitting business electronically now, which is great. Firelight is on IME's website, imesinc.com, and usually the carriers that are on Firelight are mostly annuities, but we have a couple of life insurance carriers that are on Firelight. American National has its own portal that is on our website for electronic submission. And then as far as most of the life insurance carriers, they go through iGo eApp Solutions, which is a very easy platform to submit business online. Here you can see all the annuity carriers that are on Firelight, and then the life insurance carriers as well. I don't have a slide to talk about the ones on iGo eApp, but if you ever have any questions on submitting online, just reach out to one of your life insurance sales directors or the case management team. Life insurance sales directors that we have here at IAMS are myself, Beth Ricklefs, Trina Murray, and Tony Butler. We have a great creative marketing team with all kinds of different resources for you. One thing that I would strongly encourage you to do is to reach out to any of your sales directors, annuities, or life. And if you have not done so, do a marketing analysis with your sales director. It's a short form that kind of gets a snapshot of your business as it is today and where you want to go. And then the life insurance sales director or annuity sales director would work with the creative marketing team to tailor make a solution for your marketing throughout the year. It's one thing I really love about IAMS. I've worked at a few different IMOs, and a lot of times they try to have a marketing solution that's cookie cutter and that is supposed to fit everybody. And that just doesn't ever work because there's 50 different states here and different demographics of where you're doing business, and one marketing strategy does not work for everybody. So our creative marketing team does a tremendous job of tailor making solutions for our advisors. We also have our IAMS Wealth Management. If you are managing money or you are considering managing money from any kind of level that you're at, it's important to reach out to IAMS Wealth Management. Even a beginner, they can help you with getting your series test passed, so that is something that you can add into your business. We always provide a trip for the top producers every year. This year it's going to be Seaside Sanctuary. Obviously you can see it's a very beautiful property there in South Carolina. If you have any questions about the qualifications, reach out to one of your sales directors. And then please do follow and like us on Facebook and LinkedIn. That's where you're going to get all the up-to-date information on IAMS. We have constant webinars that we're doing to help educate the advisors that we work with, plus articles and all kinds of good things. And that's all I got. So I'm going to go ahead and turn this over to Nick.
Oh, sorry guys. Trying to find the mute button, or unmute button, I should say.
There we go.
Perfect. Well, hey, thanks for passing it over, Beth. Really appreciate it. And let me pop some of this lovely stuff up on the screen and we'll get kicking. So let me see. Is everybody able to see this? And I can't see their view, so hopefully you can kind of help me out, Beth.
I can't see it yet. Oh, here we go. Now I can.
We're good?
Mm-hmm.
Beautiful. Alrighty, guys. Well, hey, real quick, I know Beth said it, but I'm sure you all forgot. My name is Nick Majors. I'm the internal contact here at Pacific Life, and I work closely with financial advisors like yourself and helping implement life annuity strategies, even different marketing efforts, and work closely with folks like Beth over here at IAMS, really just to provide from that support structure. So today what we're going to be looking at is just one of those strategies that you can be utilizing with your clients and sort of thinking about moving forward, where we look at life insurance really from a different point of view. And so we call this the missing asset strategy. And the reason we call it the missing asset strategy is it's really not something that's consistently in our client's portfolio, because it's not typically thought of as being part of the portfolio. It's more of an afterthought. But I mean, really, if you're like many clients, saving for retirement, they're mostly focused, and advisors are focused on accumulating assets. But often what we sort of fail to realize is this missing asset piece. And the missing asset is, in this case, life insurance. And we utilize that because it can be a great part of a diversified retirement strategy. It can provide great financial protection, especially against premature death, which is the typical, we'll call it life insurance framework that we're used to. But what we're going to take a look at today is where the option where we kind of flip it on its head a little bit, and the opportunity to build out a source of supplemental retirement income later by utilizing the cash value buildup within the life insurance policy. And so as we go through this today, we're going to discuss a few of the risks that can impact your retirement income, explore how one of these strategies can sort of help you address some of these risks. So I'll kind of pop over here. These are one of my favorite pages, and that is lovely disclosure pages. Hey, so everybody read that. It's a good time. It's fun to peruse. And I'll be shooting these slides out, by the way, to Beth. So no need to scribble down all your notes real quick. If you have any questions, pop them in the chat box. I will try to address them as best as I can. So as we talked about with retirement planning and as financial advisors, that I would say is arguably something that you are thinking about a day in and a day out basis. You're managing money, you're either helping provide annuity solutions, life solutions, something of the sort. But most advisors, their main goal at the end of the day is, hey, how do I provide my clients to have some protection against the unknowns in retirement? And we look here, right? We've got insufficient retirement income. That's probably the number one fear, I think, of most clients and probably even ourselves. We've got an uncertain tax environment, and that's especially true if really you look at just kind of where the debt is in this country. I think we just raised our debt ceiling again as a government, and I believe there's a little bit of political turmoil on how we're going to handle that, but that seems to be a consistent issue about every 2 years. If you look at the current national debt, we're north of 32 trillion. About 5 years ago, we were at 28 trillion. So it's growing substantially, and there's consistent attacks on our tax environment, right? And then we're going to look at impact of the volatility returns. As an advisor, how can you help reduce this risk for your clients? It's a huge impact and can really just make the difference between, hey, my income lasts only to age 85 versus my income only lasts me to age 95. So just the volatility of returns and how to actually manage this is a key piece. And then, of course, there's fees associated with all these products, right? There's fees associated with annuities. There's fees associated with your assets under management. If any of you are doing AUM, my guess is you're charging within the 100 bips range, give or take, a little more, a little less. But there's fees all over. And so obviously the retirement return has to outperform the fees in order for this to really be all well and worth it. And when you're looking at these, I mean, these clients are asking themselves for the retirement income piece, what's going to happen to my family if we deplete our savings, right? What am I going to do later in life? Or if you're in the tax environment, well, when you retire and you start facing higher income taxes, ask your clients, how are you planning to combat this? Because that's one piece that maybe isn't taken into account. Maybe you think you have the right amount of money, but if you get certain charged 5% more in taxes, well, that can be a huge impact. Or volatility of controls, hey, is there a way to manage this extreme volatility during retirement? I can't imagine having retired, 2019 to now, we've seen such just the highs and lows throughout this current market, and we kind of don't know where it's going to go. How can you as a client feel at ease, right? And this is a potential solution. And then, of course, like I talked about with the fees, right? How will the cost of your investments just affect your future potential income? That's some things that we really want to look at individually as we kind of pop through here. So the biggest piece we'll start with first, right, is, hey, for your clients, insufficient retirement income, how much money will you really need in retirement? Do you think 70 to 80% sounds reasonable? Many of us vastly underestimate that percentage. They think around 70%. However, we don't account for all the expected costs, some of which I already alluded to. And in actuality, we're going to most likely need more than that, especially with inflation rates where they are. I haven't even touched on that piece, but there's so many different factors that are really playing into the piece of, hey, am I going to have enough for retirement? And I think a lot of people think that what they need is not actually what it's going to be, and it's a huge missing piece in that conversation with your clients, just kind of spelling out all the different aspects and the different really dragging factors on their portfolio that can have a toll and have an impact. So as we look through here, this is a quick overview of ultimately the workforce confidence in, hey, do they think they have enough money for retirement? And as you'll see, this starts from the 90s going all the way to 2022. So this is our most recent study that we could pull. And you got to ask your clients, hey, will you and your family have enough to sustain your standard of living for those retirement years? And if you're looking at these confidence factors, really only 28% of Americans think that they'll have sufficient retirement savings. That's not at all the arena that we want them to be in, right? There's quite a big piece of them that don't feel they're going to have enough in retirement. As financial advisors, how can we help them feel at ease? And then there's another risk that many Americans are really failing to consider is, what if the primary income earner dies? So what if the income earner in your family dies prematurely or before they retire or haven't saved enough for retirement? How does the family going to cope with that? So that's the typical structure that we think of life insurance for, right? Hey, that's some death benefit protection that can help supplement it were something bad to happen to Miss or Mrs. whoever it may be in their family that is providing this income and providing this income to their family. So this is just, I think, a nice piece to kind of show your clients that, hey, you're not alone, but there's definitely a ton of folks out there who are not confident. And with only 28% on that bottom right-hand corner actually being very confident in their retirement income, that leaves a lot of wiggle room for us as financial advisors to have this conversation. So as we go into taxes, one of those bigger components is that taxes have changed, right? I just talked about how our current national debt is 32 trillion. We've got the ultimately the debt ceiling on our government at this moment, and they're working through that. And with debt continuing to rise and inflation continuing to rise, our government is sort of in need of money, right? Uncle Sam needs to get paid. Like it or not, our government has to function in the business in some capacity. They do have to stay. At some point, they have to pay off debts. Otherwise, the value of our dollar can collapse and so many different things from a macroeconomic level. But taxes are going to continue to change. As you look through this, this is an overview of, hey, we've got income taxes. So on the normal take home, we've got capital gains, Medicare, Medicare payroll, personal exemption. But if you're looking from 2012 to 2018, I like to look at specifically the capital gains and the income tax rate. For our higher income earners, they're going to be in these top categories. And we've slowly gone up. We went to 37% now. We're at 20% for the capital gains rates. These numbers are most likely going to continue to go up. Again, our government needs a way to be paying off their debts, and the solution is to adjust tax levels and adjust that in favor of the ones that are most able to provide that, which are top income earners. And if you look, we've already kind of started or seen some of the, and I put in quotes, like tax attacks. For example, the Secure Act passed, I believe that was 2 years ago now, used to be able to just take your IRA and pass that to the next generation, and they could have ultimately a stretch IRA, right? Never have to empty it out. They could just do so when they were going into retirement. Whereas now with the Secure Act, what we've already seen our government do is saying, hey, if you stretch that IRA, we don't get a piece of that pie. We want a piece of that pie earlier. And so now when you pass that IRA on to the next generation, if it's not utilized, you have to empty it out within 10 years, which means Uncle Sam's getting their money within 10 years. So we've already seen some of these tax changes move forward. I think they're going to continue to happen. And again, as an advisor, it's something that you want to kind of touch on with your clients and set the precedents that, look, these are unknowns. We have no idea which direction they could go. They very well could go the opposite direction if something were to change, right? Hey, I would love for taxes to go down in retirement, but are we confident in that? Are we sure that that's something that can truly happen? Financial advisors, we want to help our clients plan for the worst and hope for the best. And I think that's really where we're at this moment is, hey, look, let's plan for taxes to continue to go up. Let's look at a different asset that can help us with some tax advantage components, but at the same time, still be viable for retirement income. And then we bump into volatility returns, right? The volatility in returns can be a huge impact. And I don't want to get into all the nitty gritty on the left-hand side, but what we're looking at here is ultimately $1 million of assets and someone who's retiring at age 60, they're pulling out about 50,000 a year. We're showing it increasing annually for inflation at 3.5%. I'd argue that number's a tad low for our current environment, but the slide's a little bit older. and they're earning 6% annually. So, you know, zero balance at age 89 for a sequence of returns that is level, right? And just moving forward at the way it is. Our average life expectancy, by the way, just so that way this can kind of put it all in the frame of reference, for a 60-year-old male is about 80. So give or take that level, you might want to say, hey, is this realistic? Is this not? Age 89, I think that's fine. If you look at a varying portfolio instead of the average 6%, right, which is our dark blue, or I guess for our colorblind, maybe just normal blue, and then you've got to look at, hey, what happens on our sequence of returns? Well, the volatility piece, it can be good or bad, right? In this case, it's going to extend the life of your investment from now age 89 at 6% on average to, hey, we're going to age 93. We've got some negatives in the early years, right? We've got a negative 16.2 here, but then we've also got some nice up years of a 9, a 14, a 13. So it just depends on the sequence of those volatility of returns, which is unfortunately something that we cannot control. The only thing we can control is the levers that can help adjust for it, right? So this is on the upside. This is where things turn really great for your clients if they receive positive sequence of returns risk. What happens if we receive negative, right? We just talked about, hey, the average life expectancy for someone in their 60s is age 80. Well, again, the green, you're barely making it to 80, leaving nothing left for the kids, nothing left for the spouse. And again, it's the same sequence of returns, it's just reversed. So this one is in order, right? We start at 1.5. This one ends at 1.5. So it just depends on the sequence of returns risk. And that's the biggest component, is we're not changing anything here other than the order. And the fact of the matter is the order isn't something that we can control. This economic environment that we're in isn't something that we can expect norms out of. And so because we can't expect norms, we need to find an opportunity to pull our client's portfolio into an opportunity, or I should say into a tool that can help us adjust for this extreme volatility and help us weather the storm. I would very much like for everyone to be at age 93, and I know at your clients, you want all of them to have that money going out to age 93, but you've got that risk currently in your portfolio if you're not utilizing something that can have that downside protection, where they can potentially run out at age 80. And that's basically some point that I think, and by the way, these are all client friendly slides, so I'll shoot them over to you. To me, I think these are great conversation pieces just to have with your client and show them, hey, here's what it does on average. Here's what it looks like if you do great. Here's what it looks like if you do the reverse. And they can see the impact that it has on their retirement income. And as you'll see, this is a quick piece. I believe it's from Franklin Templeton that we pulled it. But another portfolio of $1 million, they're taking withdrawals of $50,000 a year. This time they're only increasing by 2.5% for inflation. And both portfolios have the same average return. In this case, it's a 6.09% return. But as you'll see, in scenario A, right, that's going to be our blue. Hey, the portfolio experiences strong early growth in the beginning. And you can kind of see that towards the bottom of the slide if you look in the numbers. But we account for more than $950,000 at 80 years old. That's not a bad number to be hitting at 80. Late growth, however, is not enough to overcome those early losses. And so if you start looking at the scenario of option B, well, we go from having 950 at retirement of age 80, or should say passing away at age 80, to only have 106. And again, we're looking at the same thing here where the averages are the exact same, 6.09% average return for both, but the sequences in which we got them is extremely different and vastly different. And that's going to have an impact on that compounding effect, that take home of the client. And ultimately, that's the difference of $843,000 net to your client. So again, just another piece to really help kind of drive that point home, that this is a risk in our retirement currently, and it's something that if it's not currently being accounted for, that we might want to start moving towards. So this is where the life insurance component comes in, right? Hey, what if there's a product out there on the market that can give you financial protection against premature death? We sort of talked about that. That's the general focus of, we'll say, normal life insurance. But then in here, we've got index-based crediting rates. we've got guaranteed minimum interest crediting rates, and you've got a source of retirement income. And I would like to add to that it's a tax-free potential retirement income. So for me, I think this can play a great we'll call it solution, especially to your top income earning clients. They're the ones that have the most exposure to that tax risk. They're the ones that frankly have more exposure to that volatility risk because they have larger portfolios to be working with. And they're the ones that would most likely fit into these opportunities. So if we look at it, just kind of looking through tax characteristics of all the different, we'll call it financial tools that you've got in your belt, you sort of look at life insurance at the very bottom, and it plays a role very nicely. And I go back to those high income earners because they're also the ones that face contribution limitations, right? Hey, they maybe can't get into a Roth IRA, or is the max that they can even put into an IRA worth it based off of their lifestyle? If you're making $250,000 a year and maybe you haven't started saving for retirement income until your 50s, I think the number this year is like 7,200 or 7,100 for an IRA. Is that going to be sustainable? Is that going to be enough money to put away for you for retirement? My answer is probably no. So life insurance, no annual limits on contributions. Now it's all after tax dollars, but the growth within the cash of the policy is tax deferred. You can take out income from it tax free via withdrawals and loans. There's no penalties as well, right? So if you're trying to make that nest egg early, maybe you have a younger client who's got a quite large sum of money and they're contributing, maxing out their IRA, they're throwing quite as much as they can in their 401k, looking for other avenues of safety and looking for other investment choices. Life insurance can be a great structure for them because there's no penalty on early tax. So you take it out before the withdrawal period, no 59 and a half limitations, you can take it out whenever you want. It allows that flexibility if they were to retire early. And of course, death benefit, like we've talked about, it's income tax free. There's no tax based off of that. So I'm showing this slide. It is how IUL works. That's ultimately what we're talking about. But I would like to caveat, this is not just for IUL. There are some great VUL products on the market as well, which I personally love, that have IUL buckets built into them. So for the sake of this slide, this is how it was built. It's index universal life, and I will say that that will be most likely 90% of your focus sales. However, there is a great argument, in my opinion, for variable life, especially for someone who's younger. In my age range, I'm more thinking for variable because I've got a longer time horizon to grow my money. And then I've still got 0% downside protected indexes within a VUL that I can kind of run for safety towards. So just know that there's multiple options on the market. However, for most clients, I think they will fit in the indexed universal life strategy. And just for those of us who are maybe not as familiar with really life insurance and structuring of it, so the beautiful part of it is, and you'll work with your life marketers here at IAMS, is they're adjustable and can be designed specifically to your clients. So you've got the adjustable death benefit. We've got cash value that goes into the policy. So that's our water here, right? You're throwing it in there. We have to take out the premium loads, which is taxes, ultimately the sales tax. Net premiums go in, the water fills up. It then gets reduced by the monthly charges that are focused on the insurance. So you've got admin charges, you've got a coverage charge, you've got the cost of insurance. However, it's also getting refilled when this money is getting fixed account crediting provided by the insurer, depending on whatever account they're in, or you've got indexed account options. And the indexed accounts, it can vary based off the carrier. Pacific Life has S&P based indexes, as well as we've got a couple volatility control indexed options. All of these have 0% floors. Some of them, there's no upside, there's no cap. Some of them, there's a cap of 9% on our S&P. So the beauty of these is you've got that downside protection, but you've got upside potential, right? And that can be a huge impact on that sequence of risk or sequence of volatility. And it can also be a huge risk on adjusting for your tax environment like we were talking about before. So how do you get that money out? Bottom right hand corner here, you can take that money out tax-free with policy loans and withdrawals. That's the beauty of life insurance, is the tax-free nature of it, and really the ability for your client to access this and utilize it in years where they need to control their tax environment. You know, I think about it, for example, if your client's fully invested and all their retirement income is in an IRA and a 401k, Well, that's all income taxable. Like we were talking about before, what happens if tax rates go from maybe 37% to 43%? Well, you maybe need a bucket, a bucket, so to speak, that you can pull a little bit of this money out to reduce what tax bracket you're going to be in retirement, right? You could pull out 10,000 from the life insurance and the other 40,000 from your IRA, and that can help you keep in a lower tax environment, ultimately getting you net more benefit to your client. So again, this is a tool to utilize. I won't say that life insurance is, maybe you can structure it this way where you use it for retirement income every single year, but I think a lot of folks are looking at it from a supplemental piece where it's, hey, we're going to look at what we're taking out in retirement income each year and decide maybe we utilize it in years where we're almost going to be in a higher tax bracket, or we've got 0% floors. Maybe in a year where the market is not performing favorably, why would I deplete my investments that have already experienced the negative 20 or 30% when I could pull it from my life insurance policy that has a 0% crediting rate on the floor? And even if the market did 20 or 30% negative, it only experiences zero. Well, that can help reduce that sequence of returns risk. So just a few things there. And now we talked about this a little bit, right? And I don't want to gloss this over because I think this is an important part of life insurance, and it needs to be understood by the financial advisors and frankly by the client, so they understand that there's a cost to it, right? There's no free lunch except at Costco if you're getting samples, but even then you technically paid for that membership to get in the door. So right, there's not a whole lot that is free in this world, but there are fees associated with it. That doesn't mean it's necessarily a bad product or a bad strategy. You just have to understand the fees and it has to make sense. So fees and charges can definitely have an impact on that future potential income. And how can the charges really affect it, right? You've got those three components like we talked about. We've got death benefit, we've got cash value, and we've got ultimately the supplemental retirement income. But as we'll look through here, there's quite a misconception that life insurance charges can be too high for it to make sense for the supplemental retirement income. The first thing to realize is that life insurance is for people with the first thing to realize is that life insurance is for people with a life insurance need, right? So in this case, normal life insurance, it's for those for income replacement. However, looking at it for an income additive in retirement. And so as we look here, you've got the relationship between death benefit and cash value, which we kind of went over. And you'll notice that each premium is going into the cash value, which will then get boosted by any of the crediting that you receive, less the monthly charges. And this is where you'd ultimately take out, this dark blue in the bottom right, those policy loans and withdrawals in retirement. And really, life insurance is going to have higher acquisition cost, which ultimately means that it's going to have a longer time horizon for it to make sense. So if you're looking to fund life insurance and take out the income potential of it in 4, 5, 6 years, that's probably not going to be ideal because again, there is a higher acquisition cost to it 100%. And that's because the financial risk for the insurer is higher in the early years of the policy. And you see this right here on the bottom, right? Death benefit is many times greater than the premiums paid into the policy. That is the risk of the insurer. That's what we're taking on, is that risk in the first, we'll call it 5 to 10 years. And that is why it has a higher acquisition cost up front. However, over the long term, and again, I think most of us as financial advisors, we plan for retirement for the long-term time horizon. It actually can be very favorable, and from a policy charges standpoint, will not be as impactful as you might think. So real quick, we're going to run through a life insurance illustration. Particularly what we're going to do is we're going to break out the fee structure of it, just so you guys can see. I don't like to hide behind the pretty numbers on an illustration. I want to show you guys the actual fees and get into the weeds of these first, because I think that's the biggest apprehension for financial advisors. And that way you can kind of see how you would run through it and why it makes sense before you obviously start positioning to your client, before you start calling Beth and Trina over at IAMS to get some potential numbers. This can make you feel a little bit more comfortable. So again, I'll shoot this slide out. If you click here, it'll pull up the exact illustration that we're about to go over in the next pages. So this is what ultimately it's going to look like. It'll have everything on there from the ledger all the way down, but I'm just going to show you guys the charges pages and kind of run through. So this is an example of our charges pages reflecting, the current base assumptions, and the values are definitely going to vary based on age, sex, risk class premiums, the structure, the design, pretty much everything and everything. But what we focused on this particular option is a 45-year-old male. They are going to be paying $50,000 a year for 10 years, and they're trying to overfund this life insurance policy. So what we did is we took 50,000 and said, hey, what's the lowest amount of death benefit that I am legally allowed to buy in order to put this $50,000 in for over 10 years? And what you'll see is high acquisition costs, just like I said. The first year, the return on your investment's not exactly great. We're looking at column 15. It says policy charges as a percentage of gross accumulated value. So you put in $50,000, you've now got $37,000 net. That's not exactly a great return, right? 34% of the gross accumulated value was in charges, 15% year 2, 8% year 3, 5% year 4. It continues to go on, right? However, once we start getting towards the end of this time horizon, 1.2% total charges cost. And again, we were sort of talking about before, right? From those advisors that are on the phone today that manage assets, what are you charging your clients in your book of business? My guess is it's somewhere around 100 bips. It's probably not 122, but it's somewhere around 100. So what happens when we start going even longer time horizon? So with these plans properly funded and properly planned for, you look at it by year 20, well, the net cost of your life insurance has been about 25 basis points. I think that is a really strong argument for if I'm charging my client 75 basis points to manage their money, I'm willing to reallocate a portion of this funds into the life insurance component because it's charging even less than I am and it's giving a tax-free benefit to them. So it's got that ability to, again, control those uncertainties in retirement, but the impact of fees is not nearly as really impactful as I think you first see. Now, again, this is the previous slide. It is a high upfront cost, so I don't want to leave that under the table. However, as you go through time, policy years 11 through 20, it gets much lower and lower and lower. And there's different ways that we can structure these to reduce these costs. We can drop the death benefit to reduce that cost of insurance piece. And again, your marketers can kind of go into this to a little bit greater detail. But this is a huge component that I think should really sort of turn our eyes to say, hey, this is a tool that I most likely haven't been utilizing for life insurance or for retirement income, and to sort of divert your attention a little bit and show you, hey, there's great potential here. And then you can kind of see this as we move forward, even when we go into years 21 plus, right? Same story is this number continues to go down, and it's going to get a little bit higher costs as you age back up in your late 80s because the cost of insurance get more expensive. But during, we'll call it peak retirement years, age 65 to 84, you reduce the cost of your client's assets heavily, right? They're not paying that much in charges. It's purely basis points. So I just think that's a key piece. And mind you, this is while they're taking out retirement income every year. So they put in 50,000 a year in the top left right here for 10 years. We let that thing grow through year 20. Now onto the current slide we're on, age 65, we start pulling income age 66 down to age 84, $87,000 a year in retirement income on an annual basis. Net cost to the client of fees, about 16 basis points. So again, the value there, and keep in mind, what would you have to earn in another investment to meet this $87,000? Well, let's dive into that a little bit. So assuming $50,000 a year for the 10 years, just like into that illustration, life insurance, we were showing a 5.21% crediting rate. The policy charges started at 34% in year 1, and at its lowest was 9 basis points. Now a mutual fund, we're going to let it show a little bit more upside potential on the average annual crediting at 6%. we'll show a management fee of 90 basis points and then a sales charge of 4. And then of course you've got long-term tax rates to be taken into account. And then you can also even look at, and keep in mind, this is also a flexible piece that we can do on our illustrations, but you can adjust these every which way you want. If you want to change the fee, if you want to reduce the mutual fund earnings rate, if you want to make it higher, that's something that you have the ability to do and the flexibility to do on our software. And our folks at IAMS can help you walk through that as well. But again, look at another investment, 6% rate of return, maybe with just a 1% management fee. So you could argue that's their money with you and whatever AUM you've got. And you can then compare it to our life insurance contract. So the same design, 87,000 in income. We're showing the death benefit of the life insurance, the cash value of the life insurance, the net outlay. So here's what they put in, here's what they get out. Then let's compare it to if they put that same 50,000 in a mutual fund or in that other investment option that we're talking about. What you'll notice is as you start taking out that income, you run out of money from the management fees and from the taxes component on the mutual fund in age 79. You run out from a taxes component age 30, or let's see, age 77. So just given those assumptions, you're seeing that life insurance is providing a net longer retirement income because you've diversified them away. Not saying that mutual funds are bad, because they're not. They're a great and a key piece of life insurance, or a key piece of their investment portfolio. But life insurance can help you from diversifying on that tax standpoint, diversifying that volatility, really of returns piece. So again, we've got this exact slide in our illustrations, and it is client friendly. You can ultimately look and say, hey, here's the total after-tax distributions. You get 1.7 million from your life insurance. You get 1.1 from your mutual fund. Your other investments pulling you 963,000. Assuming distributions are gained, right? The life insurance is equivalent to ultimately 126,000 of taxable income, assuming a 31% tax rate. Again, you can adjust this tax rate whatever you want, and it'll pop out the exact same number adjusted for it. So in your mutual fund, you got to earn 126,000 ultimately, I should say, in your income taxable investments, 126,000 in order for that to make sense. I just think that's a huge differential. And again, something great to show your clients of, hey, here's why we're looking at this and looking at this alternative asset, or should I say missing asset of life insurance. So this piece is just kind of going into the gross interest rate that you would need to match the investment in. So again, we were going at 5.21% on the life insurance. The mutual fund would ultimately have to return to 6.39% or a 7.8, depending on which year of the cash that you're looking at. And that's the other component too, is you've got the death benefit piece of the life insurance, even when you were in the income taking years. So at age 85, you also got 279,000 after the loans are paid off of death benefit. Mutual fund would have to hit 8% returns to meet that after it's taking out all that income. So it's just a nice comparable piece of, hey, not only does it show you on this slide the tax effectiveness of it from a actual distribution number, but it shows it to you as well from, hey, potential rate of return that you would actually need to match in your other investments in order for it to beat or make sense to compete with the life insurance. And you can kind of show your clients money, or you show your clients this, right? Just compare tax efficiency. These are ultimately the three main buckets. I'm sure there's a few others out there in the world, but my guess is most of your clients have your money on the left one. Income taxable, that 401k, that IRA, that's typically where most money is these days. A little bit of it in the capital gains bucket in the middle, right? The stocks, mutual funds, real estate. And often, again, for those high income earners especially, we're really not taking a big enough stab at the overlooked assets of, we've got a Roth, which again, you got contribution limitations on, as well as income limitations on to qualify for one. Munis, this might be a tad different story, right? Munis are providing a little bit better return than they certainly have been, just based on the Fed rate hikes that we've had. And so this could be a potential option, but again, is it a long-term solution? I'm not sure. Life insurance, you've got that 0% floor, you've got that upside potential, and it's all on a tax-free basis. So I'm not saying that this is the only bucket to utilize, but I think there is a healthy balance between the three. So again, you can adjust your clients tax bracket in retirement based on their given situation. And again, this just kind of goes into this piece a little bit more. When properly structured, it's just another piece of the pie, right? Cash value life insurance can be added in addition to all the current investments that you can have. It's really, to the bottom right, it's a hedge against the rising tax environment. That's what we utilize this for. So yes, it's got the sequence of returns risk that it can control, but in my eyes, I really view it as a hedge against the rising tax environment while still providing value from a true income potential and income generator. So, when you look to your clients, just sort of ask yourself, hey, are we missing this asset in our portfolio, and have that conversation with them. Do you need life insurance protection? Maybe we use it for that normal structure where we don't buy it for the lowest death benefit possible, but they actually truly need it for income replacement were they to pass away. Maybe we need it because we're already maximizing our contributions to qualified retirement plans and we're looking for another safe space to store our money, and we might as well look at a tax diversified one. And then, tax diversification for retirement income, we talked about that enough, but the ability to adjust your client's tax bracket in retirement is huge. The other piece is, does this make sense for my client? Is they need the time horizon. Realistically, this says 15 years. We can definitely structure them to be lower, but we'll say like ideal perfect picture world, 15 years is a great time horizon just to get that return on investment. Because again, there is a little bit of a higher acquisition cost to life insurance than potentially some other investment options, but there's also nothing like life insurance from a tax criteria standpoint, from a downside protection standpoint. And then of course, it is life insurance at the end of the day. They need to understand that you don't buy life insurance. Unfortunately, you qualify for life insurance and you have to apply, you have to go through underwriting, make sure that you're healthy enough for it. Even though you might be a great fit for all these other reasons, you still have to qualify for it. And that's a conversation you want to discuss with your IMS folks. They can definitely help you with that underwriting process. And then again, of course, the biggest thing as well is with life insurance, they have to stick to the plan. We showed the individual age 45 paying $50,000 a year for 10 years. It doesn't have to be that large of a number. It can be 5,000 for 10 years. It can be 7,000 for 12 years. Like, you pick the number and the duration, we can back into the retirement number that you need, but they have to be able to stick with the plan, because life insurance, it is adjustable and it's flexible, but the second that you veer off course with the plan, it's adjusted our charges costs that we've talked about, the cost of insurance piece. There's not enough premiums to take that into account. And that can have a negative effect and ultimately a negative return. And we don't want you to have a negative experience with life insurance, which is why we are showing this as clear as possible. Hey, look, there's higher upfront charges on it, but over the course of the long haul, it's lower. And there is that ability where they need to be able to pay those ongoing premiums that they said they were going to pay. So it makes sense for the right client, for those high income earners, for those folks that are already kind of maxing out those qualified assets. And that's really what you have to just ask yourself and ask your clients is, hey, are you a good fit for this? And really paint the picture for them. So that's all I've got for today, guys. Just going into life insurance, supplemental retirement income, we can definitely get you a sample illustration. I will make sure to shoot this slide deck out to Beth and she can disseminate it to you guys. But if you want to see a sample illustration with your client and we can dial it up for those alternative investments, you want to see with the mutual fund, or you want to see with the muni or the other investment or whatever it may be, we can run it side by side, the life insurance and the other investments, and just show you, hey, here's the impact, here's the benefit, and walk through it with you side by side as well as with the fees, so that way you feel comfortable with it. But again, that's really all I had today. I hope you guys learned a little bit of something, and at least it wasn't super boring, I hope. So again, my name is Nick Majors. I'm your internal contact here at Pacific Life. And yeah, if you need anything, please feel free to reach out to me. Always reach out to Beth and Trina and their crew over at IMS. They'll make sure to get you over, connect with me, and we can dial something up. So with that, really appreciate it. Hope you guys all have a great rest of your week, and take care.